Hey, everybody. Welcome to Market Mavericks. The Magnificent Three are back with you guys today. It was either the Stooges. I said, what the heck? Let's be magnificent today.
I like that.
Getting into it with Scott and Mike here. Where are we starting today? I mean, should we talk NVIDIA? What the heck's going on
We
here?
have to. We have
All
to
right.
talk about NVIDIA.
Take it away, Scott.
Listen, I mean, NVIDIA seemed like the expectations were too high. There was no way they could reach it, that the market was going to dump. The chart was starting to actually look a little dumpy. It was rolling over, and wrong. Absolutely crushed earnings, crushed everything. As you can see here, there's a lot of people who probably were thinking, I'm not buying this stock. It's way too expensive. But when you actually look at their earnings, that's actually getting relatively cheaper from a PE perspective, right? So the stock is not rising as fast as their actual earnings and income are. It's astounding to say, but I think that this move is justified in NVIDIA. The problem is how big NVIDIA is relative to the rest of the market. Gareth, I think you just said that when we were talking before, this is 25% of the move of the NASDAQ today is this single stock.
Just alone, and if you add in Broadcom, another semi, and AMD, those three account for half of the entire move on the Nasdaq today. So that's scary, right? I mean, you know, I talked about this in the game plan this morning, and the idea is like, have we now come from banks that are too big to fail to now companies, right? I mean, could NVIDIA, in theory, and I'm not saying this would happen, but like, do they have control enough of the economy to actually carry weight in the government? You know, does Microsoft, like, where does this stop? Do these companies essentially become too big to fail?
Mike, what do you think? I think so.
I think that it's the most important stock on the planet at the moment, and it's in a classic blow-off stage, and it's called big momentum. And I'm going to tilt. I just want to show a few charts, take like 5 minutes, and show my view on this. And you just don't mess with the momentum. As a trader, the way I look at this, way I used to trade it, the way I used to do it with clients and my money and clients' money, is you just got to have gamma positive, and you're never smart enough to pick peaks, but just go with it until it stops, and just don't get hammered when it does correct, and it corrects a lot. So I want to start with some facts that I really enjoy pointing out just recently. If you take since the end of 2021, which is right before the Fed started hiking, you take the total return of the S&P 500, it's about 10%. You take the total return of gold, it's about 10%. You take the total return of Bitcoin, it's about 10% today. But that's why I pointed, the key thing I've been saying in this business for a long time is, and I just actually went to the Metals and Mining Conference in Miami last week. I was at ETFs, and that is, you just can't hold gold anymore. It's a lot more of the gold in people and the old school people without some Bitcoin in space. If not, you know, you're seriously silly. I heard that interview with Scott, you did with Peter Schiff. I'm like, dude, you just don't want to take that risk in life, but obviously he is. So I just want to show a few key things now, how expensive the U.S. stock market is. We'll start with it relative to the commodities. Well, it's a broad commodities. This is what I show you here. This is the Bloomberg Commodity Index divided by the S&P 500. It's the most expensive since 2001, right before the big recession. It's the most expensive, or you can look at the HSI. I showed this last week, but pointed out that the Hong Kong Shanghai Index is the cheapest versus the S&P 500 since when Mao was the chairman in 1975. We have a chairman and a president in China right now. It's very much like Mao. And the only thing that's really hanging up versus S&P 500 is gold. Gold is about the same price as it was versus S&P 500 right before 2007. So that's in my commodity space. It's the only commodity I still see going up, and this is the word I keep using for the stock market. It's the inordinate burden. Just imagine if the U.S. stock market does go down a little bit. At some point, we will get a correction this year, and we'll see how long it works out. We haven't had anything near a normal correction. But what I show you in white, that's the S&P 500 divided by the MSCI ex-US, or any other stock in the world that's ex-US. It's just, it looks to me exactly like the chart did for the S&P 500 in the U.S. stock market in 1929. And I overlay that with commodities. Commodities are really, really cheap. And also, one thing that's really matters is typically the Dow goes with the U.S. stocks, and you can see how the Dow really traded well with the stock market and down with the stock market. Now it's starting to lag. It's going up, but really lagging this massive parabolic breakout. And we still have that gap I like to show you in S&P minis. We're getting further from it, the further away we get from it. But the key thing that's happening is as the stock market goes higher, as you see here, what I show you in the bottom is Fed fund expectations for Fed easing in the next year are plunging. And we're just taking those out. And I'll show you that chart in a little bit, just taking those out. Like, there's no reason for the Fed to ease in this environment. So that at some point is going to kick in where oh, we're not going to get that liquidity, and gold's hanging in there. That's what I show you in this chart. I just want to show a few more, and then we want to pivot to oil, because let's just get to oil a little bit. The key thing that matters for me in terms of commodities is I take gold versus everything, and it beats everything. This is gold versus crude oil, from the lower left to the upper right, heading that way. And there's key reasons why gold's going to keep beating crude oil. First is I just show you the excess of liquid fuel net imports. They're now exports from the U.S. And debt to GDP is rising. I think it's probably good if I pause there before, so we can move on to other things. I got a few more I want to show you, but to me, that's a key
I want to
thing
hear,
point out.
Gareth, sorry, I don't mean to circle back, but I want to hear what your thoughts on NVIDIA, because the way that it is carrying the entire market, I think it's important that we don't end that conversation yet.
Yeah, so I mean, I've been one of the sad souls to be short NVIDIA right now, so I'm not a happy camper today, needless to say. You know, for me, I keep, and this is probably my fault, is that I keep on going back to previous bubbles, right? So previous bubbles where we saw Cisco, and then, you know, what happened to Cisco from 2000, or you know, classic bubbles like we had with the marijuana stocks, and those collapsed, essentially because when you have margins that are like NVIDIA is showcasing, and I'll bring up the NVIDIA chart here, is that every other semiconductor is going into this, you know, space and trying to produce these chips, and eventually it will be commoditized, right? So the margins are not going to stay at 70 to 80. I think they had 75% margins. The margins within a year or two will be down to a reasonable level of 20 or sub 20. And then that would be my big question is does the same thing that happened to Cisco, which is basically all these other companies rushed into the space of building the backbone of the company. I still remember Sycamore Networks, JDS Uniphase, Lucent. I mean, these are numbers from my pseudo childhood when I was a beginning investor, but that's what happened. And so, you know, for me, that's been my longer term macro view. It's been so wrong right now. But I still think that eventually we will see a top on this thing as margins come crashing down. But you're right. I mean, right now it doesn't look expensive. The question is, if those margins drop from 75 to 25%, is it then expensive at that point?
Well, we're not going to find out for at least a few more months, right? So
right. Yeah, probably 6 to 12 months.
I think the floodgates are open here until the next meaningful earnings, and then you have to bet that you're going to get something down. This is something else you just brought up of mine, but it's actually an idea I've been thinking about. This is IWM, iShares Russell 2000 ETF, obviously small caps. We talked about this actually quite a bit, I think, in November on this show, when it was down here at the bottom of this range. And we were saying, man, if this thing can't hold, watch out below. Well, we've seen actually a lot of upside from small caps since then. But what I find interesting is that, you know, S&P making a new high today, I think, right? About 5,100. Yep. We're seeing, obviously, NASDAQ new highs, Dow Jones new highs. Small caps are still 18% off the highs.
Yeah.
Right. So listen, I guess if you're overtly bearish, you say, forget small caps. I say, man, while the party's going, you keep trading until the music stops, and that this is probably an opportunity where you're lagging 18% the rest of the market. But I would love to hear your guys' thoughts on that.
I couldn't agree more, man. I could not agree more. I'll just show mine. So basically, I have this breakout that has occurred already on the IWM. You can see the downsloping trend line, flat bottom, and we broke above here. We retested the line, and we're slowly starting to move up. You basically look for a breakout above 205 on the IWM, and this thing should head back to possibly. I mean, it would make logical sense to at least go back to the all-time high, since the S&P and the NASDAQ are way above their 2022 highs. So it doesn't seem like a hard ask.
Yeah, I'm not saying that like you invest in this long term, but I'm saying it should have a good 18% move into it to get up to the all-time high.
Yeah, and I think that's really important. What you're saying here is like for me, you have to differentiate between a long-term trade and the Russell, which if we do hit a recession, like I do think is coming, then small caps don't do well in that. They get smashed, right? But there's this interim period, this let's say 3 to 6 month period where people still believe in the soft landing, but maybe some profit taking occurs in the mega caps. Some of that, right? Some of that money. That's a lot of accumulation to me. When I see that volume, that tells me there's accumulation, but price hasn't started to move yet, and that might be institutional accumulation.
Yeah, if I saw this, you know, like the volume dropping as we've seen in these other periods in this range, even here, but we actually saw volume rising while this price is heading to the top of the range. So you're just looking for more volume on that pop up, but everything there confirms that it wants to go, in my opinion. Doesn't mean it will, guys, but you know, just when you look for opportunities, you want to, if you think the market's looking good, you find the thing that's lagging.
So a question for you guys is, and this is what keeps me up, right? Is that so Nvidia is having a monster move and it's carrying the market, but is this market becoming a thinner and thinner leaderboard, meaning that we know that 10 of 11 sectors aren't at new all-time highs from 2022? It's the technology sector. It used to be Apple leading along with the rest of the Mag 7. Even Tesla was up there. Now we've seen Tesla kind of fall by the wayside. Even Apple is kind of like if I bring up my chart on Apple, it's still holding on to a general trend line, and bear with me as I bring it up, but the high on Apple was made back in December of last year, and it hasn't made a new all-time high since. So the leaderboard seems to be getting thinner and thinner. But as long as Nvidia is going to go up 15% a day and put 200 billion market cap on the table, who needs the Fed printing money? First of all, let Nvidia do the work for the Fed. But does it spell trouble, basically?
I want Mike's opinion.
Well, it's only one, like you said, you got to see the break some support. And the key thing, I'm glad you brought up the IWM, and I think you have to ask yourself, I'm asking you, is the IWM or small caps going to catch up to large caps? Or meaning they even go higher, or there's going to be some reversion? And this is why I show you a key thing that really matters, I think, for small caps. It's usually the macroeconomic big picture economy globally. And what I show you in orange is the average of producer price indices from the four horsemen of the global economy: US, China, Japan, and Germany. It's minus 3%. We've never, and that's commodities. It's actually a high beta measure of inflation, but it's pure deflation. And we've never had that with interest rates this high. We've never had a spread. The spread right now is 8%. Now I can only go back 30 years. I admit that. That's a lifetime for a lot of people trade cryptos. We just have never had that wide of a disparity. So I think that's what small caps are telling you. They're catching up because they have to, but they're also pointing out that we haven't even started this point of interest rate cuts. And that's, I see right now, is not going to happen until the stock market goes down, is what I think the problem is now. Because why would you take that risk of right now, this world is, the book I read recently is called Capitalism Without Capital, how the whole world is going to intangible assets away from tangible assets like commodities and gold, and Bitcoin's an intangible asset. Is why would you take the risk of goosing inflation with the market on a tear like this? You wouldn't even consider it if you're sitting at the Fed. It's silly. Right. So that to me is a lose-lose we're sitting in right now. Every time the stock market goes up, you see these interest rate expectations go down. And the fact that they're still priced for ease is the problem. And how long have we seen that, Scott? We love to point out this. So now we're pointing where the first ease isn't out until July now. Before it was March. It's just
hey Mike, do they have on that board, do they have the predictive markets on another tightening?
Yeah, so now there's no tightening priced in yet. It's still easing. Yeah, so that's kind of silly right now to expect a tightening. That's why when people say it's a lot of that's clickbait. The market's not even priced for that. So that's what this is down. This is called rate, where it's expected. So let's just point out for this way. This is Fed fund futures. I used to trade these. The average, the price for Fed fund futures right now for May is 5.25%. Yet this target's 5.33. So that's the tilt towards easing. The thing is, that's just what markets do. But we all know that's going to get pushed back until the stock market's healthy. There's no reason to ease. And in fact, this is a very inflationary environment. It's very speculative excess. And the last thing the Fed would do is cut rates in the environment, or they're helping fuel that.
Right. And that's the question that I would have is, so I was just reading someone else's tweet, and it looks like the global market move today added $2 trillion. So we know Nvidia added by itself 200 billion approximately. But again, if you look at what Meta's up, what all these other stocks are up, you're talking 2 trillion in a day. I mean, who cares what the balance sheet is of the Fed at $7.6 trillion when you're adding that kind of liquidity? And so I don't see how the Fed would ever even consider cutting. And then the question is, which you guys just mentioned, is, okay, well, let's just say oil's right up against resistance. What if this bullish pattern breaks out? And we get another hot CPI number in March with PPI number? Do we start seeing it potentially pricing in another hike? Is that possible?
It could. Well, obviously, it's possible. That's what the market is. Let's point out the facts. The market is tilting that way right now. Oil being up about 10% on the year. Stock market, S&P 500 has already had a good year, and it's only 2 months. And the key thing about oil I need to point out is I'm comparing it to natural gas. And natural gas. To answer your question is, I'm not bullish oil. There's a good reason for oil to go up because of geopolitical events and what's happening with the U.S. stock market. But what I'm showing you on this chart is this is just a 50-week moving average of natural gas. There's crude oil in orange, and natural gas is finally getting to the low price cure. You're hearing about producers cutting back in supply. I mean, that's just how it happens. You have to hear. People have to not make money or start losing money. But the key thing is we've virtually never had a low or bottom like this in a long time in natural gas without crude oil following it. So this is a 50-week moving average. It's just starting to tilt over. If it spikes up for any reason, it takes Fed tightening out of the game. It actually hurts what's happening in Europe and China, tilting towards recession. But so I see crude oil easily heading towards 50 or 40. But it's not going to happen, I don't think, until the stock market stops going up.
Shouldn't the base case just be an endless pause?
Yeah, for now, exactly. But that's the key thing, right? A good point. Endless pause until the stock market tells the Fed start easing, and that's not even close. I mean, right now, this is an environment where you would consider tightening. Inflation numbers are hot. Stock market's on a roar. You don't throw more alcohol in the punch bowl when there's a party going on like this. You just don't do that.
Do you think that oil, I mean, one of my thought processes now is that, right, so we're still in this interim period where it looks like maybe we'll get a soft landing. You know, some of the economic data is starting to get a little softer, like retail sales last week, which is not good for the consumer. But you now have massive stimulus in China. And we know if China starts, let's say their economy comes out of absolute chaos to just being bad, that's additional demand for oil. And is that potentially at least a short-term breakout on oil until maybe the U.S. economy really starts to weaken?
So that's a macro big picture one. I want to show the key thing you should watch for China for initial indications is the Hang Seng taking off and recovering. It's a tradable bounce. It's so overdue. And you're going to have to expect the Chinese government to keep throwing, one person, Mr. Z, it's no longer a government in China, it's one person, to keep throwing as much liquidity at as possible to make it go up. Now made it illegal to sell. Okay, well, that'll make a market go higher recently, something like that. But here's how cheap it is. You're going to get a decent bounce out of that. Might coincide with oil going up and copper recovering and stuff. But that, I think all the traders on the planet are looking to sell into that because they see what's happening with the macro fundamentals. We are in the wrong stage of the cycle, Scott, for oil. It's in the high price cure stage. And that's what I needed to point out here. At least natural gas is getting towards the low price cure. Crude oil is just getting started. The average cost of production in this country is around $50 a barrel, and we're on the board at 78. So it means that supply is still coming on at a record pace, and the demand's not there. Now, the rest of the world has a problem, but Europe's heading towards recession. UK, Germany, Japan, all tilting towards recession. People say China, but China kind of refilled its SPR last year, and now they have an epic property crisis in their biggest clients, U.S. and Germany, and U.S. and Europe are having a problem. So I see your chart on oil. I just think that, to me, it's the upper end of the range. And I think the risk is at some point we'll turn around and you need geopolitical event fuel to keep it bid. And at some point it's going to fall in natural gases. And that means it can just plunge in a heartbeat.
Yeah, no, I think my bigger macro view is that oil ultimately goes down. It's more of a matter of just in the short term, does it break out and then cause the PPI and CPI numbers to pop up a little bit?
It did that last year. That was a good
talk of Fed hikes, right?
It did that last year, Gareth. It was a good trade. When that peak at 95 is right when the bonds yields peaked at 5%, and then they dropped to 4%, and oil dropped went from 95 to 70. I can easily see that. What hurts the most traders?
Yeah. So we've believe it or not, this is probably the longest we've gone without talking crypto. So let's turn our attention a little over to crypto because I'm sure a lot of people want to hear. Scott, I mean, where is Bitcoin right now? What are your thoughts on ETH?
I mean, Bitcoin, I can give you the quick rundown, just pop up my charts. Bitcoin obviously had a very key resistance here going back to these December 21 highs, 52,100. But the fact that Bitcoin is just hanging out here, we're seeing no meaningful retracement. The dips are getting bought up very quickly. We're still seeing powerful inflows from the ETF. I don't see any reason to fade Bitcoin right now. I think it has nothing but tailwinds, unless the things you guys are talking about with the macro happen to roll over. But right now, like I said, when the music's playing, you keep on partying. I think going to continue to go up. I really, really like Ethereum here. Obviously, trading right around $3,000 meaningful level. I think we're going to 3,500 without much ado about nothing. I think that's a pretty easy trade. You got ascending lows here to a flat top, basically a descending triangle, should be targeting that 3,500, 3,600 area. I mean, listen, on my stream, I titled Bitcoin to 150,000 according to Fundstrat. Tom at Fundstrat, I don't see why not. You know what I mean? He said by the end of the year, I think maybe by the end of the cycle, but I still am a believer that Bitcoin can do that, especially in the context of the election year and stuff. But I do want to show you that's really, really funny. There's that article he said. But AI-linked crypto tokens surge after NVIDIA sees tipping point. If you want to see the nonsense of crypto, like where we get really, really degenerate and stupid and our brains fall out of our ears and we get FOMO. Right. Well, here's FET. This is a AI linked coin. This is what it's done from 54 cents to $1.15 in the last 2 weeks. You've got AGIX Singularity making a new all-time high right now. Remember, guys, altcoins generally trail Bitcoin 80, 90%, even at this point in the cycle. You're talking about new all-time highs from previous cycles. IOS was another one. I mean, these things are just going absolutely insane. This is where I'd look for the bubble personally. Right. I know actually Rand was on Crypto Town Hall this morning, Rand Nooner, and he said, listen, guys, I shorted every single AI coin yesterday thinking NVIDIA would miss, and he got crushed. Right. And he admitted it. And he said he got crushed. But listen, I think his sentiment is correct. His timing's just bad. That's the problem with being a trader. Right. You'll eventually be right while you're broke, unfortunately. But, you know, I do think that this will roll over. But really, man, I remain extremely bullish on crypto. I think Ethereum is going to catch up big time. Lots of tailwinds.
One question I have about Bitcoin is like, so yesterday going into NVIDIA earnings, I was like, all right, this is the most important thing for the stock market, right? It's the bulls will party if it's good. The bears will be like, oh, we finally have a victory. And I also said, and it'll be equally as important for Bitcoin because it's
nothing.
risk on, risk off. And it literally has done nothing. Is that a concern at all? Or it's just like,
oh, it's the most beautiful thing in the world because I'm a maximalist on the non-correlation. And if, Bitcoin doesn't move like the tech stocks on the biggest day for tech stocks, then you can't be claiming right now that it's high beta to tech stocks, right? You just can't. Not right now. I'm not saying there won't be those times. I imagine on downside that it will. I've been making the argument for as long as I can remember, but certainly for the last year that Bitcoin is Bitcoin. It's not gold. It's not a tech stock. It's Bitcoin, right? And it's small and it's traveling as it should be. And so for right now, I'm absolutely thrilled that it did not moon alongside NVIDIA. And equally would have been upset if it had dumped when it did, because flat Bitcoin, when everything else is in chaos, is exactly the sharp ratio pitch that you want to make to every investment advisor. That there's an asset with idiosyncratic risk you can put in your portfolio that might not travel with everything else.
So you could make the case that Bitcoin was the leading indicator. They both popped through high 5 handles, Bitcoin and S&P 500. S&P 500 dipped back below that 5 handle, and Bitcoin said, no, we're good, in a 50 handle, and it still is. So could make the case it was the leading indicator there.
Yeah, either way, the very fact, like Gareth said, I think a consensus view would have been that no matter what NVIDIA does, everything else is going to follow, especially something that, trades like tech, and it just didn't. So to me, I'll take that for the day. I'll take that as a win for my narrative.
Nice. Where do we turn our attention to, right? I don't know. I think
let's go to Japan. Come on. We got to go back to Beanie Babies and baggy jeans and hypercolor t-shirts and the invention of MTV, because the last time Japan was here was 1989. They're finally into 1990 here, guys. This is a Nikkei chart. And guys, I think that probably both of you actually will use this as fuel potentially accurately, because we've seen this with markets of how long it can take to return to a high when things really go bad.
Yeah.
Right, Mike, you showed me on the, how long it took the Dow and the S&P after the 2000. It can take decades to return to your highs. This is over 30 years for Japan to return to an all-time high in its stock market.
So I think China is in the early stage of the way down, maybe near the bottom. So maybe it's another decade before it gets to the all-time highs. But it hasn't even started the implosion that Japan went through. What you point out there is I worked for an IBJ, Industrial Bank of Japan, and man, they just felt it, and we saw all the. We ended up becoming Mizuho because of that failure, and got fired and laid off and all that stuff. So feel it well. But to me, it's worse in China now. And what I've read about it and the valuations in China were worse. And also what they've done geopolitically with Mr. Z tilting towards the unlimited friendship and the bad guys with Russia, North Korea, and Iran. It's just horrible. And what you see now is you see a significant bear market, obviously in recovery, but we're in the downside of that trade. And what you see in that chart is those sharp rallies. We should get one of those in a Hang Seng. And I think the rest of the world's just looking to sell into it in terms of China. So that's why the tilt is towards significant deflationary forces globally, potentially recession, and the shining star remains the S&P 500 and what's the only stock that matters, and that most important stock on the planet is still NVIDIA, and it's still going up. So hey, momentum's your friend.
Yeah. Yeah, absolutely. And I think it's an amazing thing for investors to see, is that how long it can potentially take. And we kind of live in a US market where it's been the favorite place for investor money for so long. But if you look at Brazil's stock market, it's been since 2008 since they've made a new all-time high, and they're way off. Look at China. China had a double top a few, maybe like 5-7 years back, and then the previous high of that double top was back in, I think, the early 2000s. And so, we've been the favored investment for the world, but it does make me wonder if that's going to continue, if we have prolonged neutral to higher inflation, or what the economy does.
So that you see a chart like that and what we showed you earlier, and the market really pops at the end of the year, and they're hoping the Fed eases, and the market's taking its own Fed easing out, and actually we've seen a tilt towards tightening. So that's a lose-lose scenario. And I don't know where it ends, but I look at some of my stuff. I look at trucking, complete recession in this country, paperboard demand in recession, diesel demand in recession. The same price, diesel demand in this country is the same as 2015. That's never happened. That we've had an almost 9-year period of flat diesel demand. Unleaded gas demand is in decline. So for my space, I see nothing but recession, and I look over the stock market. So you better keep going up, because if you go down, that's severe deflationary forces kicking in. I just don't know what the catalyst will be, particularly as we tilt towards this election.
Man, so where else are we looking to invest, right? So if it's hard to buy the US stock market up here, if it's hard to buy NVIDIA up here, Bitcoin maybe, right? If you think it's still going to go up, but are there other investments? We talked about the Russell, because I think that's the key, is like there can be bearish views of maybe NVIDIA is overdone. I am short NVIDIA, and that's not going very well, but IWM, I think, is a long. Do we like Brazil? What do you guys think of the EWZ chart? Are there any others out there?
You pull it up, man. I haven't. That's when we get off my radar and start looking. I've gotten so sucked into crypto over the past few years that it's really my base case is looking at that. But I haven't even looked at Brazil. So
this is the Brazilian market with the high back in 08 on the EWZ ETF of 100, and it's trading at 33.5. So it's pretty remarkable.
I see a consolidating bear market, and you draw the line. But I mean, it's been trending down since the peak in 2008, and what's going to make it go higher?
I mean, that's lower highs since 2008.
I see a wedge pattern, and the rule about these kind of things is typically the big pictures, they break out to the upside, but oftentimes you need a head fake. But I don't. And then there's the macro is it's okay. What happens to that if the global beta S&P 500 just drops for a normal correction that it hasn't done, for regular recession, on the back of all this tightening and inverted curve and all those kind of things that don't matter anymore? I just look at that as you're still subject to good old beta in the U.S. And if you take that chart, just take it from 2007, it's just melting. Obviously, it's how you look at it, but maybe that's a tradable. Maybe it's going to break out. So, okay, maybe it's breaking out. Maybe it's breaking out there.
That's what I was kind of wondering. Is it almost looks like maybe you've had at least a short-term breakout here where it's gotten above this little trend line here. This is the weekly, monthly chart. But again, the question is, I do wonder if resource-rich countries, and this was some research I was doing recently, like what are the most resource-rich countries? Not necessarily with oil, because again, I think that's more a commodity. But what about gold? What about uranium? What about these other commodities? Which countries have those? And in a market where, or in a world where printing money is just to become the norm, and UF deficits are the norm, wouldn't the countries that have the most resources like gold and other precious metals and rare earths be maybe an interesting area to hide?
Well, I appreciate you pointing it out, because we're having a complete breakout rally in intangible assets led by the U.S. And one of the most significant intangible assets are cryptos, and Bitcoin's there, and U.S. just approved ETFs. And what's happened on Bitcoin? What's happened in China? The old school, they are the biggest buyer on the planet of gold. It's the word the World Gold Council used was colossal buying of gold, and they've pushed back on crypto. So we're seeing that great shift. But what I like to point out is one thing we do have a case for, as I pointed out early on, is that as far as the most significant measure of intangible assets is commodities. You mentioned commodity countries. The Bloomberg Commodity Spot Index is the lowest versus S&P 500 in almost a full quarter century. Okay, that's a tradable bonds. And I think your points for where's their value, but also part of that is when I look at what's happening with PPI, and I see that as far as where to put your money, I just still say I don't give investment advice, but you still get 5% in T-bills. And at some point, I think there's going to be the thing you're going to want to do is have that dry powder when things really collapse. And I think taking shots at shorts once in a while work as long as you're conservative and use stops. And obviously, I'm sure you're good at that, Gareth, but your average person is. But to me, the value is going to be is when we do get some normalization, having plenty of powder that's earning 5% to just wave in and say, I'll take that. And it's not even close. It's not even close. Now, that's why we're going to get a tradable bonds and maybe in China now, but it's sure at depressed levels. And those rallies, those short covering rallies are vicious.
They are. They certainly are. All right, guys, it's 3:30, or at least 3:30 Eastern time. 30 minutes in. Let's call it a day. As always, follow these gentlemen. So follow their socials. And, man, great chat today, guys. Wonderful topics. And I hope everyone enjoyed it. And we'll see you all next week. All right.
Thanks, guys.
Thank you.
Take care.